Hello, and we are presenting our group project for the course Finance of Retirement and Pensions. Our group is looking at the San Mateo County Employees Retirement Association pension, also known as SAMSARA. So to give a little bit of background about SAMSARA, San Mateo County is located in Northern California. SAMSARA has a total member count of 10,621. It has current assets of around $2.6 billion, and it uses a discount rate of 7.5%. In the chart at the bottom of this slide, you will see that SAMSARA has 7 plans that range several different types of employees within the county. Looking back at SAMSARA's recent investment performance, the top chart shows historical returns for SAMSARA, and the bottom two graphs show first the actual versus expected returns of the pension, and second, the funded ratio of SAMSARA, which in 2001 was 98.6%, and now in 2013 it has fallen to 73.3%. So expanding off of this reduced funded ratio that SAMSARA is currently experiencing, we can think about the causes of this in several different ways. This is the result of a combination of poor returns, improved pension benefits, and a shortened amortization period. And these factors lead to increased unfunded liabilities, which increase employer and employee required contributions. And ultimately, all of these things lead to a reduction of resources for the county of San Mateo. And in the two charts at the bottom of this page, you will see that over the past 10 years, SAMSARA has led to a much larger increase of employer contributions than employee contributions. And these contributions from employers now result in about 7.6% of the total of San Mateo County's annual budget.
We engage in some economic analysis to assess the health of SAMSARA. And we use the actuarial report's current assumptions, which include a 7.5% expected annual return on investments, as well as a 3.25% expected inflation rate. Under these assumptions, SAMSARA is considered sustainable. These assumptions, however, could be optimistic, and they place SAMSARA just over the margin of sustainability. If investments underperform by 1% annualized, the plan will be insolvent in 62 years, as you can see in the table below. And if inflation rises by 1%, then the plan will be insolvent in 54 years. And this is even with our model incorporating a couple of relatively generous assumptions, including that both the employer and its employees will continue to contribute to the pension program at the same high rates. And that for the county, this means that continuing to contribute about 8% of the county budget into the program until it's theoretically fully funded. And thereafter, employer contributions are assumed to still continue in order to meet normal costs. In addition, this assumes that the workforce will not grow, i.e. there be fewer liabilities than if the workforce were allowed to grow. And so the many market environments in which SAMSARA will be unable to fund its obligations raise our concern for the health of the system. This next slide highlights that employee and employer contributions are both quite crucial for the sustainability of SAMSARA. At current levels, they are equivalent to about an additional 7% of return on the pension's assets. And if neither the employer nor the employees want to contribute any further to the pension plan, as we see in scenario 2 here, the plan will become insolvent in 21 years. And this is assuming the same assumptions that the actuarial report has provided us. Freezing the plan entirely in scenario 3 actually leads us to our intermediate result. It's slightly worse than the base case ongoing scenario because of the absence of employer and employee contributions in future years, i.e. those aren't able to provide towards the assets of the pension. And as a result, we can see that if we take the same actuarial assumptions, that we are right on the margin of sustainability. Here's a history of the reform measures that have affected Samsara over the past decade and a little bit more. In September of 1999, Senate Bill 400 was passed, and it improved state retirement benefits, which would increase the amount that Samsara would have on its liabilities. And going forward, there were attempts and successful attempts to rein in the amount of pension benefits that were offered to future employees. And there have also been a couple of interesting developments municipally, including the fact that the city of Stockton has filed for bankruptcy, the city of San Bernardino has filed for bankruptcy, and that this San Jose and San Diego have both passed pension benefit reforms, which are currently both being challenged in court. And it'll be interesting to view the developments in these legal cases going forward.
So after performing our economic analysis and looking at the reform history of the last decade, we have come up with a proposal of our own that has three parts. So the first part is that we would request that the actuary calculate and present future employer contributions given a range of realized returns and not just using the discount rate. The second part of the proposal is that we request that the savings be calculated and presented in the scenario where pre-2002 accruals are adopted for all employees moving forward. And the third part of the proposal would be to urge Samsara to remain up to date and educated on current pension legal developments. So our plan for implementing this proposal would be to utilize social media to encourage the members of San Mateo County to sign our petition by educating them on our findings from this presentation and also the current health of the pension system, and hopefully bringing this petition to Samsara to urge them to follow up on the proposal that we have requested.
To recap, here are a couple of the conclusions. The problem that we have defined includes that Samsara's funded ratio has decreased substantially over the past 10 years, and over the same time period, lower than expected returns as well as improved benefit plans have led to increased unfunded liabilities as well as increased government contributions. Recent reform efforts have reduced benefits for new employees, but won't necessarily have a great impact on the funds until several years out. The analysis that we have performed shows that although current assumptions keep Samsara sustainable, the margin of sustainability is relatively small. These assumptions that the actuarial report has provided us could prove to be a little bit optimistic, and if they're stressed a little bit, they can lead to the fund becoming insolvent. And the sensitivity analysis that we have performed as a result raises concern for the future health of this pension. There are a few unfeasible solutions out there. One would be to reduce the benefits of current retirees. One would be to generate significant turnover of the employee base. And another would be to produce earnings in excess of the discount rate of 7.5%. While it'd be nice to earn returns in excess of this, it is hard to rely on this going forward. And there are a few feasible solutions, including increasing the sensitivity analysis that the actuaries perform on the range for a range of investment returns, increasing the information that is given to the general public about government contributions, as well as monitoring the legal development of cases such as San Jose's Measure B and Stockton's and San Bernardino's bankruptcy cases. Thank you.